Hello, it's Angie from UK Money Wisdom. Many of us are hearing talk about the April the 5th deadline because each year on April the 5th at the stroke of midnight, thousands of UK savers are going to lose money they don't even know they have. It's not a fine and it's not an actual mistake. It's a reset that the taxman won't remind you about. And it could well cost many people thousands of pounds one way or another. Now, most people assume if something important is about to expire, someone official will tell them. But in the UK tax system, that's not how it works. These allowances are silent. They don't flash warnings, they don't send letters, and they don't roll over. They simply reset quietly, whether you use them or not. You see, the UK tax year runs from the 6th of April to the 5th of April each year. And at midnight on the 5th of April, the current tax year ends and a new one begins. Many tax allowances, which are legal tax-free limits set by Hmrc, do not carry forward. That means if you don't use them by that deadline, they disappear permanently. Hmrc does not send reminders because these allowances are considered your responsibility to use. Today, I felt that someone needed to show you the 5-step checklist to plug the leak before your allowances vanish forever. If you're over 50 or planning for retirement, step 4 is the one most people forget, and it's one of the most expensive mistakes you can make because it affects not just this year's money, but future tax bills too. Missing it once might not seem dramatic. Missing it repeatedly over 10 or 15 years can quietly cost thousands. Many people focus only on income tax and forget other allowances like capital gains or pension relief. Your tax allowances are like yearly vouchers from the government. Each one has a value. If unused, that value is lost. These forgotten allowances often represent the largest missed savings because they affect investment growth, not just income. Think of April the 5th like a supermarket voucher that expires. If you don't spend it, you don't get a refund, you just lose the value. And the important thing to understand is that this isn't a penalty. You're not being fined. The government isn't charging you extra. What's happening is that an opportunity disappears. And when opportunities disappear in finance, they rarely come back. Let me show you. Unlike bank interest or savings, allowances are not stored for later. They are time-limited tax permissions. Look at this example above that shows you the ISA allowance that we can have of up to £20,000. And if we don't take that out in 1 year, is it lost if unused? Yes, it is. Same for capital gains. If we don't use the £3,000, it's lost if unused. And personal allowance, £12,570. Yes, for that year, it's lost. If you don't use them within that tax year, you see, they reset to 0. We're all currently battling something called fiscal drag. The government has frozen your tax-free thresholds at £12,570. As inflation pushes prices and pensions up, a bigger slice of your money gets caught in the tax net. Fiscal drag is powerful precisely because most people don't notice it happening. There's no announcement, you see, saying, "You're now paying more tax." There's no headlines telling you your threshold quietly stayed the same while everything else went up. But over time, more of your income slips above that frozen line, and many end up paying tax. For example, so you've got your personal allowance of 12,570, frozen, we know, until at least April 2028. If your pension rises from £12,000 to £13,000 due to inflation, you now pay tax on that £430 difference between £13,000 and your personal allowance, the frozen personal allowance of £12,570. Even though your real spending power hasn't increased. So even without tax rate rises, you still pay more tax. Okay, let's get you protected where we can. Use these 5 shields to fight back before they reset. Step 1, let's look at the £20,000 ISA shield. You have a £20,000 limit. Inside this wrapper, your money is wonderfully invisible to the taxman. No tax on growth, no tax on dividends, no tax on withdrawals. It's really a very good thing if you have the money to invest in it. That's why ISAs are often described as one of the most powerful legal tools available to ordinary savers. Once money is inside that wrapper, it stays protected year after year. Interest can build, investments can grow, dividends can accumulate, and none of it gets taxed. That's what freedom feels like. Once money enters an ISA, it stays tax-free permanently, even if it grows to £100,000 plus. And even if you don't have £20,000, many of us don't, move whatever cash you can. Once it's inside, it's protected for life. If you wait until April the 6th, that portion of this year's allowance is gone forever. And that's the key idea here. It's not about having the full amount. It's about using what you can. Even small amounts added consistently each year can grow into substantial tax-free savings over time. If you only deposit, say, £5,000 this year, the unused £15,000 cannot be reclaimed later. Next year, you get a fresh £20,000 allowance, not £35,000, which is that £15,000 lost, plus your new £20,000 allowance, because that £15,000 lost portion is gone permanently. Let's look at step 2, the government bonus pension tax relief. Now, step 2 is literally the closest thing to free money in the UK. For every £80 you put into a private pension, the government puts in £20. That's a 25% instant boost. Very few financial opportunities give you an immediate return the moment you contribute, but pension tax relief does exactly that. Before your investment even has time to grow, it's already been increased by the government. Let me explain. You have basic rate tax relief, which works like this. You pay £80, the government adds £20, total invested £100. so £20 more than you pay. This happens automatically for most pension contributions. And if you're a higher rate taxpayer, then lucky you could be claiming back an extra 20% or even 25% through your tax return. But warning, the money must land in the account by the 5th of April. Don't leave the bank transfer until the final hour. It takes time to arrange these things, so start doing it as soon as possible. Remember the important timing rule. The contribution must be received by the pension provider before midnight, the 5th of April, not just sent. You see, bank delays can cause it to miss the next tax year, and that timing detail matters. Payments can take, as I said, time to process, especially near deadlines when systems are busy. So giving yourself a small safety margin is one of the simplest ways to avoid missing out. Step 3, your annual personal allowance use. As we all know, your personal allowance is the amount you can earn before paying income tax. For couples or those with multiple income streams, you each have a personal allowance of £12,570. If your income this year is lower than that, you might be able to withdraw a chunk of your pension entirely tax-free. Many people don't realise they can choose when to take certain types of income. And that flexibility means you can sometimes use unused allowance space before the year ends, rather than letting it go to waste. Look at this example. You have income of £10,000, so tax owed will be zero, because the £12,570 allowance means you can earn up to £12,570 without paying anything. But if you have £14,000 in a tax year income, then you'll be taxed on £1,430, which is the difference between £14,000 your income and the personal allowance of £12,570. So say you only earn £9,000 this year, you could withdraw up to £3,570 extra from a pension and still pay no tax. Use it now to bridge the gap before the new year starts. It's about smoothing income. And smoothing means spreading withdrawals across years, so you stay below tax thresholds, instead of taking large lump sums that will trigger tax. So, instead of big spikes that trigger tax, you create a steadier pattern across years. Think of it like levelling out a road so you don't hit sudden bumps. Step 4 is your capital gains allowance. This is the one people often miss. You have £3,000 capital gains allowance, say. If you have shares or investments, not in an ISA, of course, we've dealt with that, and those shares or investments other than ISA have gone up in value, you can realise gains tax-free of up to £3,000 because capital gains only apply when you sell something. Many people forget about them until much later, but planning sales strategically can make a major difference to how much tax you ultimately pay. As you know, capital gains tax applies when you sell assets that increased in value. For example, you bought shares for £5,000. You sold them for £8,000. That's a gain of £3,000, isn't it? So what's your tax due? It's nothing, because it's within that £3,000 capital gains allowance. Experienced investors harvest these gains every year. If you don't, and you sell everything at once later, you could face a large tax bill that was completely avoidable. That's why this step is often described as quiet tax planning, rather than complicated investing. It isn't about taking risks, it's about timing decisions sensibly. First, we must understand that gain harvesting means selling investments gradually each year to use your allowance repeatedly. So, a bad example of investing is sell £30,000 gain in 1 year. That will be taxable, I can tell you. And a smart example is sell £3,000 gain yearly for 10 years, tax-free every time. Property gains usually involve additional rules and main residence relief. So if property is involved, it's always wise to double check the specific rules that apply to your situation, because those rules can vary depending on the property and how it's used. You can find a lot of this information on gov.uk, so do use the government website and have a look at capital gains so that you understand it clearly. Your main home is usually exempt from capital gains tax, but second homes, buy-to-lets or inherited property may be taxable and must be reported within 60 days of the sale. Okay, the final step, number 5. Do your tax code audit. Did you know millions of UK taxpayers are on the wrong one? If you see BR or OT or W1 or M1 on your payslip or pension statement, you might well be paying the wrong tax every month. Tax codes look like small details, but they control how much tax is taken from you before you ever see your money. So even a minor code issue can quietly affect every payment, eating up your money. Let me explain. You have a tax code BR. All your income is taxed at 20%. You have no allowance applied, nothing. If you have a code of OT, again, no allowance. You're likely overpaying. And W1/M1, that's the emergency code, that means temporary overtaxing. You see, incorrect codes often happen when starting a pension mid-year. Incorrect codes often happen when you have multiple income sources, or Hmrc are missing updated information. A 5-minute check online today on gov.uk could result in a refund later. Don't let them hold your money longer than necessary, because when too much tax is deducted, it isn't lost, but it is temporarily out of your hands, and you might want to invest some of it into an ISA, but you miss that allowance and it's gone forever. And having access to your own money sooner rather than later always puts you in a stronger position. You can check your tax code instantly in your personal tax account on gov.uk. If wrong, you can request correction. I have given you a full video on how to access gov.uk and how to use it, so I shall put the link in the description below. So as I was saying, you can check your tax code instantly in your personal tax account on gov.uk. If it's wrong, you can request correction. Refunds can take weeks or months, so correcting early prevents unnecessary deductions. Please note that Hmrc refunds are not instant and they don't normally arrive tomorrow. So correcting things early is always better than fixing them late. Prevention is quicker than refund recovery. Here are some typical refund times. Online correction, the time it takes is 2 to 6 weeks. If it's a cheque, it will take up to 8 weeks, and end of year reconciliation will be after July, following the end of the tax year. You now see that the system isn't designed to remind you to use every allowance. It's up to you, isn't it, to claim what's legally yours? The UK tax system is based on self-responsibility. Hmrc calculates tax, oh yes, but does not optimise your finances for you. Using allowances correctly is legal tax efficiency, not avoidance. Knowledge is power. So check your ISA, top up your pension, use your allowances and audit your tax codes. Do it regularly. None of these steps are loopholes. They are all official allowances written into the rules. Using them simply means you're making full use of what you're entitled to. If you found this helpful, please hit the like button and subscribe so the algorithm shows this to more people before the deadline hits. We only have a few weeks left, and sharing information like this can genuinely help someone else avoid losing money they didn't even realise they had the chance to keep. And please remember, financial deadlines reward preparation more than speed. So make some notes with structured reminders, which is one of the most effective tools for protecting your income. And also, please remember my financial disclaimer, because this content is for general information only, and it's not meant to be specific personal financial advice to anyone. It is based on current UK tax rules and public guidance up to date as at 2025-26 tax year. Because please remember, individual circumstances vary and rules can change. So please do seek proper advice. Check with gov.uk if you're unsure about anything. And there's wonderful free advice, as I will put in the description below also. That's all from me for today, and I'll see you all again very soon. Bye for now.